Hello. Well, today we're going to look at the first of a couple of videos on the exchange of assets. So as you will recall from your reading, the fair value standard is actually the standard. It's the method that we use for almost every exchange of asset. The exception is just that. Not very often would we have an exception. So here's what it means though. The fair value standard means that when you exchange one asset for another asset, that you will actually calculate a gain or loss on the asset that you've given up so that we are finished with that one asset, we can get rid of it, take it, derecognize it actually, and then bring in the new asset. So we're going to do an example of that today. So here we have a trailer that cost us $17,000 to buy, and accumulated depreciation is $12,000. So please note that this question we're doing is really just about exchange of assets. So I'm saying or assuming that our depreciation expense has been brought up to date to the day of sale. When you look at disposing of assets in a later chapter, almost all the time we're going to have two entries, one to bring depreciation expense up to date, and then the other to sell the asset and recognize a gain or loss. So this is up to date. Now, our asset has a fair value of $6,000. And the way this works is the standard says first we would value this transaction based on the fair value of what we give up. So we're giving up our trailer, we have a fair value for it, it's $6,000. So we're going to base our transaction and our calculations on this fair value. Now there is again an exception to that, which is if the asset you're receiving has a more readily determinable fair value, then we can use the fair value of the asset we're receiving. So, for example, if you were going to exchange an asset for common shares of a company that's a public company, well, you might just say, hey, I can look at the closing price today at the stock market and get an exact value to the penny for these shares. That's probably a better indication of fair value than an appraisal on your trailer. However, here we're not doing that. We're saying, okay, we're going to use the fair value of what we give up, which is the trailer. So the very first thing we want to look at is, well, the cost of this trailer is $17,000. The accumulated depreciation is $12,000. So, we're using easy numbers here. I know you can do this in your head. We have a $5,000 book value. So there's a book value. Now, if fair value is $6,000, then we can see quite easily that the fair value is $1,000 higher than the book value. So we're going to have a gain on this exchange of $1,000. So at this point, we can start to build our journal entry. And one of the things we need to do is calculate the value of the truck that we're receiving. So normally we would just say, oh, look, we gave them a trailer worth $6,000, the truck must be worth $6,000. However, we also received $2,000 cash from the owner of the truck. So this is a pretty old truck, isn't it? It's not worth a lot because we gave them $6,000, but they gave us $2,000. So really, we gave up a total of $4,000. The $6,000 trailer less the cash we received. So the value of the truck, when we build this journal entry, is going to be a $4,000 truck. Okay. Now I would like you to recall that accumulated depreciation is a contra account. So this is a contra account to our trailer. As soon as we give away the trailer, exchange it, and we don't have the trailer anymore, we cannot have accumulated depreciation for it either. So when you dispose of an asset or exchange it, you must credit out the historical cost And of course, accumulated depreciation is a credit balance, so you need to close it as well with a debit for $12,000 in this case. So we have everything we need now to start building our journal entry. So it's kind of traditional to start with cash. So let's look at our $2,000 cash that we're going to get. Now we already calculated the value of this truck, and we believe that it's going to be $4,000. We'll see in the end if our journal entry balances. So we need to close out accumulated depreciation. So let's do that. And that is our $12,000. Now, at the same time, we did calculate that we have a gain. And of course, gains are credits. So you can use an account something like this, gain on disposal of trailer. There's our 1,000. And of course, the historical cost of the trailer is $17,000, and that has to go away too. So what we have now is a complete journal entry, and we have 18,000 in debits, 18,000 in credits. So the journal entry balances, and that kind of matches what we had calculated for the value of the truck. So that's all there is to it.